Tomorrow may be a disappointing GDP number again. Where do you fall? Strong or not strong?
Not strong. If you look at the numerator of output per hour, which is gross domestic product, and the denominator, which is hours, which are very large, we're getting a weakened evidence of productivity. And that is a key statistic which tells how the economy is functioning.
In fact, Greg Ip just told us he also was concerned about weak productivity growth. The weakest, he said, since the 1970s. It means less slack for the Fed, and it means for the U.S. a smaller economy in the long run.
Well, it's a smaller economy now. And it is basically because of the fact that productivity is crucial for a market economy. And what's been happening in the United States is, for a lot of reasons, which I can get into, which I've written in a book, or a couple of books, gross domestic savings has been declining in this country for years. And it's fundamentally caused by, the data show, a very large surge in essentially the bipartisan push on entitlement programs.
So entitlements are crowding out investment in this country, and that's what's hurting our productivity?
They're crowding out savings, and because you look at savings are the critical aspect in investment, the rest incidentally is borrowing from abroad. It's crowding out capital investment, and capital investment is key to productivity growth. That has slowed down quite dramatically, and productivity has followed right along.
So what do we do? Is the Fed somehow at fault in the middle of all this, as was reflected in the tenor of the hearings this week and the move to audit the Fed and do all of these things? Is the Fed the culprit?
No. The Fed basically is doing a number of things, some which work and some which don't. One which has worked and is working is a significant increase in the amount of purchases of securities on the balance sheet, not to induce lending on the part of the private sector, but to push rates down. Because if you take a look at the balance sheet of the Fed, they have bought up very large chunks of treasury notes and mortgage-backed securities, suppressed the real long-term interest rates, and that arbitraged into a very significant increase, or I should say a rising pattern in the way of price-earnings ratios, capitalization ratios in real estate, so all income-producing assets.
That's what's behind this NASDAQ, if you want to call it, move to 5,000 back to those new highs?
Yes.
So the Fed is at fault then?
Well, it's not at fault. It's actually, I presume one would say it's good, not bad.
Except we've seen how this ends before. I guess that's why there's all this concern, is that we've seen what has happened in the past when asset prices have shot up and there have been low interest rates. And does this all potentially end as badly as it did the last couple of go-rounds?
Well, it depends. Right at the moment, equity premiums, which is a measure of the extent to which common stock is required to have a particular yield over and above riskless bonds, that number is actually average. It was extraordinarily high right at the edge of the crisis, the highest in 50 years. It's come down a good deal as the market has gone up, but we're not yet there in a position where it's crisis. However, the real issue here is going to be when real interest rates start to move up. Remember, it is real interest rates plus the equity premium, which is the total return on common stock. And a goodly part of what's going on, remember, European rates are lower than ours. Portuguese rates are lower than U.S. rates. Now that's.
What do you think about that?
Well, it's induced by the fact that since it can't be a problem of liquidity, we don't actually have liquidity, but we have the potential for very large liquidity. It has got to be that effective demand is extraordinarily weak. In fact, the way I measure it, it's probably tantamount to what we saw in the later stages of the Great Depression.
That's how weak you think the global economy is right now?
Well, it's not anywhere near what the problems were back then, but we haven't seen anything like that since then.
Is that a policy response then? Is it something central banks who have cut interest rates all over the map lately are supposed to respond to? Or is there something very, very different that ought to be done here?
It's fundamentally the fiscal issues. It's the fact that we are absorbing all of the capital investment, not all of it, but a substantial amount of the capital investment from the economy. If you look at the United States by itself, we've had virtually no pickup since we crashed in 2008. There have been lots of false dawns. I mean, the market goes up, now and up and down and down.
Well, it's up. The stock markets are pretty significant.
Stock market is straight up, but the economy is not.
Right.
And the basic reason why the economy is not, if you just look at the data, is a shortfall in long-term capital investment. By looking, for example, at non-financial corporations who have had very significant liquid cash flow, the amount of that liquid cash flow they choose to invest in illiquid long-term assets is at a very low level. And in fact, in 2009, 2010, it got to the lowest levels since 1940.
And there you go.
And that's where the issue lies. It's all confidence. It's risk, because nobody knows what's going to happen out there. We're dealing not only with uncertain tax rates, which you can't tell because of the size of the deficit, but, well, we've got global warming, we've got all sorts of things going on in the Middle East which don't seem to be simmering down, so that nobody wants to invest in the very long term.
Important point.
And that's where the biggest weakness, in fact, it's where the weakness in the economy is in the United States, it's where the weakness in the Eurozone is, and it's essentially pretty much globally.
We have to go, but I just want to quickly ask you for your reaction to the acrimony, if you will, over Janet Yellen appearing this week to testify at the Fed. Just from your own personal experience testifying before Congress, is it always acrimonious, or has something changed in your experience since your chairmanship?
It's always acrimonious.
Always acrimonious.
Bubble creator, and then Bernanke they put in, who basically said, if necessary, I'll drop money out of the helicopter, and he said that before he even went in. So I say the mainstream has drifted so far over the deep end that my whole analysis, the 700 pages, is out of the mainstream. And so the prescriptions, which are, a half a dozen pages, are in the same place. But the real debate in this country is, has all of this new permanent Keynesianism, and it's ironic with the death of Margaret Thatcher today announced, that we thought in 1981 at least Thatcher and Reagan had killed the Keynesian mythology that we could borrow our way to prosperity once and for all, that by having the government borrow money and passing it out to people so that they'll buy more flat screen TVs was a good thing. All that was dead. Here we are 30 years later, and we're back to the same old thing on steroids, and not only in the fiscal authorities, but in the central banks. All the central banks are pure Keynesian, propositions.
Then do you believe QE infinity is going to lead to just runaway inflation?
No, it's going to lead to an ultimate collapse in the bond market, because if you believe the bond vigilantes are dead, then you're delusional. The bond vigilantes are laughing all the way to the bank because they're putting on the ARB, buying the 10-year, let's say it's yielding whatever it is this morning, 1.7, and they're borrowing overnight money on the repo at 10 basis points, capturing the spread, and sleeping like a baby because they know that Uncle Ben said the overnight rate is 0, will be to 215, and I'm going to be buying $85 billion a month in the long-term market, and thereby keeping the price up. Now this is dangerous because the minute the ARBs realize the Fed is going to stop or slow down or hint or even imply something, and they begin unwinding that trade, the selling crescendo, the selling avalanche will be monumental. They have no clue of how they're going to stop the selling once it starts.
Clive, is that part of, or at least one of the parts of David's analysis that you do agree with?
I think there's something in it. I mean, I think he's exaggerating. He seems pathologically prone to exaggeration these days. But there's a germ of truth assuring what he's saying. You know, we all know that the exit strategy issue is a daunting one for the Fed. And with interest rates this low, you bet people are making mistakes, people are making investments they shouldn't be making, and unwinding all this is not going to be straightforward. But the question is, what is the alternative? I mean, Bernanke is right, in my view, to provide monetary stimulus, to help the economy recover, to support demand. David would call that reckless Keynesianism. I think it's sensible macro policy. One of the things David says in his book is he's against macro management in principle. He doesn't want any counter-cyclical policy whatever. I find that very hard to take seriously.
Well, let me respond to that, because I think 40, 50 years shows that macro management is the equivalent of a narcotic. It gives the economy a good high for a while initially, but it then becomes politically habit-forming.
Is it the economy or the market?
No, it's both. The Congress cannot stop stimulating the economy, because there's always some Keynesian economists will say it's a little too cool, or it's slowing down, or it's speeding up, but don't stop now. And the Fed...
Well, they're stopping right now. They're stopping right now. The fiscal stimulus is being withdrawn, and in my view, it's being withdrawn too soon.
Well, I mean, if you believe that you can just borrow your way to prosperity, bury the next generation in debt, well, of course, that's what we're doing. And the thing about bubbles, we're in the world of the bubble blind. And I would say my opponent here this morning is one of the bubble blind. And, these are the arguments to have, because frankly, in 2007, I heard it, we're in the Goldilocks economy, everything's fine. Ben was trained by Greenspan, and so therefore we can count on Ben. They had no clue the freight train's coming down the track. He didn't see subprime, he didn't see the housing collapse. They couldn't even tell that housing prices had gone up 200% from 95 to 208, and they couldn't see a housing bubble. Now, if you think people who believe all of this are giving you good advice now, or that this needs to continue, that's fine. I don't believe it.
David, hang on. Clive, hang on. We need to take a quick break.
Greenspan now says that even if he did know the true dimensions of the housing bubble back then, he wouldn't have been able to do much to stop it.
The presumption that you could incrementally diffuse a bubble was a fantasy. Clearly, you cannot diffuse these things unless you hit them right on the head and break the economy, essentially break the potential profitability that is engendering that sort of stuff.
So you're essentially saying there's nothing the Fed could have done
to prevent the bubble?
Correct.
Yes, we could have. We could have basically clamped down on the American economy, generated a 10% unemployment rate, and I will guarantee we would not have had a housing boom, a stock market boom, or indeed a particularly good economy either.
So those who sit here now and in retrospect say Alan Greenspan really could have done a lot more in terms of speaking out, or in terms of getting down and dirty and sending examiners into some of these operations that were ultimately creating the subprime mortgages.
Had we tried to suppress the expansion of the subprime market, do you think that would have gone over very well with the Congress? When it looked as though we were dealing with a major increase in home ownership, which is of unquestioned value to the society. Would we have been able to do that? I doubt it.
No one in Washington stopped the party. Not the Federal Reserve, and not the Securities and Exchange Commission. Neither tamed the Wall Street firms